Hello traders, welcome back to the Forex Gig. In today's video, we are going to explore a powerful tool that can help you better your understanding of price movement in the market. This tool is called the Liquidity Swing by Lux Algo. Liquidity is the lifeblood of any market, and knowing how to spot key liquidity zones can give you a significant edge in your trading. By the end of this video, you would have a clear understanding of how to identify the liquidity swings, use them to anticipate market reversals, and refine your entries and exits for better precision. Stay with me until the end of this video because this strategy can be a game changer for your trading approach. Now, we have to start by understanding the liquidity swing indicator by Lux Algo. Setting up this liquidity swing indicator is a straightforward but is as important to configure it correctly to maximize its potential. This indicator, as we can see from by screen, highlights key liquidity zones and swing levels, which can act as strong support and resistance area. These levels are crucial for identifying potential reversal points or breakout zones. We have to first start by knowing how to configure this by the chart configuration. The time frame where we spot these levels are important. Liquidity swing indicator works best on all time frames, but it is most effective on higher time frames like the 1 hour or the 4 hour chart, as the case may be. But in this case, we'll be making use of the 1 hour chart because it helps filter out noise and focuses on significant liquidity zones. The second thing we need to pay attention to is the pivot look back period. The pivot look back period determines how far the indicator will search for swing highs and lows. A short look back period will result in more frequent swing areas, while a longer period will highlight only the most recent specific levels. We have to see these areas. These are the pivot areas in charts. These areas in the chart. The third one is the swing area calculation modes. There are two modes for calculating swing areas on this indicator. The weak extremity mode uses the range from the highest or the lowest wick to the opening/close of the candle. I repeat, it uses the range from the highest or lowest wick to the opening or close of the candle. They also have the full range mode, uses the full range of the candle to include both the wicks and the close of the candle. The fourth thing we need to pay attention in this indicator is volume filtering. This indicator allows you to filter out swing areas based on volume or the number of times price has revisited on zones. This ensures that only significant liquidity zones are displayed, reducing clustering on your chart. This indicator has already done that work for us. These are the areas that it has filtered out, only areas that we can see potential swing points or potential liquidity zones in the market. Now let's see how we can implement this strategy. When trading with liquidity swings, the goal is to enter trade at high probability zones, either a swing high or a swing low. Once price reaches this zone, we have to enter the trade at high probability zones. Once price reach this zone, we have to enter the trade at high probability zones where price is likely to react from. There are several ways you can approach different scenarios depending on how price behave around the liquidity zone. I'm taking my time to look for a perfect example. For reversal trade, you would want to look for price approaching the liquidity zone. When price approach the liquidity zone, either a swing high or a swing low, either the swing high or a swing low. In this case, we'll make use of this area. We'll make use of this previous area. When price approach a swing high or a swing low, this could come in form of a long wicks. When you observe when price get to this zone, we have to observe for signs of rejection, and they may come as a long wick. When price came above this previous swing high that has been marked out by this indicator, we will look for signs of we have to look for signs of reversal. And as we can see, we can look at this week, they are showing us signs of reversal. So if price shows clear signs of rejection at the liquidity zone, this could indicate that the zone is holding and a reversal could likely occur. In this case, you would want to enter a trade in the opposite direction. So we would have to enter a sell trade in the opposite direction of the market. For example, if the price rejects at a swing high, from this example, swing high, we would enter a sell position and consider trading to the downside. As we can see, it played out after the sign of the rejection. So another way we can implement this strategy is from the breakout trade. We'll have to look for areas where price will break out from. If price approach a liquidity zone with strong momentum and breaks through it decisively, this could signal a breakout. As you can see from this area, price broke out from this particular liquidity area that was marked by the indicator. This side is a liquidity area, these are the marked out zones. So price broke out from this liquidity area with a strong momentum. This confirmation is backed up by our volume. So if I add my volume indicator, it will help me see what the volume was showing to us at that particular time. And as we can see from the volume indicator, there was an increase in the volume while price was breaking out of that zone. Once confirmed, you can enter in the direction of the breakout above the swing high with strong momentum and volume. It will be an opportunity to enter a buy position. So we can enter after the breakout has been confirmed. After effect strategy is the retest entries. After a breakout occur, it is common that price should retest broken liquidity zone. It don't always happen, but most time we expect price to come back to retest, like you can see from this example here. When price broke this particular liquidity area, price broke and came back to retest the zone before continuing in the direction of the breakout. You have to wait for price to, if you want to take this trade, you have to wait for price to come back to where it broke out from, and if it holds as a new support or resistance, you can enter the trade in the direction of the market. So we have to, in case of a buy scenario, after price breakout from the liquidity area, we wait for it to come back and retest that new resistance formed area. And if price rejects from that side, you can enter your trade in that direction of the market. Alright traders, we have come to the end of this video. By now, you should have a solid understanding of how you can use the liquidity swing indicator by Lux Algo to identify key trading zones and improve your trade entries and exits. If If you found this content helpful, do not forget to like the video, subscribe to the channel for more valuable trading strategies, and turn on the notification bell so that you wouldn't miss out on any updates. Thank you for watching, and I will see you in the next video.